Thanks for tuning in to BloombergQuint. The markets have an uncanny way of shrugging off bad news, if any, and just chugging ahead. We've seen this time and again over the last few months. Today is no different. Not that it was a shocker, but everybody anticipated maybe some bit of a disappointment here and there in the GDP numbers that came out, or frankly for the Q4 earnings as well. And yes, the GDP numbers did oblige. The numbers were very bad, much lower than what the street was working with. And remember, this is as per the new series. We don't even know what the numbers are as per the old series as well. So even those could be a bit disheartening. But to talk about whether this is a temporary aberration and whether things can improve in the quarters ahead, what about the Q4 earnings? What about the market picture at large? A quick interaction with a very special guest. Needs no introduction. Pradip Shah of IndAsia Advisors joins us from his office. Mr. Shah, thank you so much for taking the time out. Lovely having you. Thanks for agreeing to do this.
My pleasure.
What did you make of the GDP numbers? I think DMON has clearly shown that there is an impact. Is this temporary in nature?
Well, it is temporary. The impact is probably not as visible as it should be because, as you know, the GDP numbers don't necessarily take count of consumption. Consumption is a fill-in-the-blank kind of thing. And actually, consumption was affected by demonetization as people didn't have money to spend, especially in the rural areas where they had a bumper harvest last year because of a great monsoon. And therefore, one would have expected a surge in consumption demand. Now, that pent-up demand will come back now, and the expectation of the monsoons are very good. So certainly, we see great possibilities of consumption being very noticeably better. So consumer consumables, consumer durables, housing, all will see an improvement going forward. But there is one caveat, and that is this GST. It's an event risk. How is it implemented? You know, the rates are still being adjusted. On 3rd June, we will see some more rates for leather footwear and so on. But assuming the rates are reasonable, there is some question about that because some things which were 18% have now gone to 28% and so on. There is also the process risk, the systems and the processes. No, don't forget, millions of businesses will have to upload their information every month accurately. It'll have to be captured accurately, matched accurately, and then reconciled and so on. And payments have to be made in time, otherwise you won't get credit. So there's lots of teething issues that one can envisage. And that can be very disruptive to the economy.
But you would reckon that FY18, I'm just tying 2 or 3 things together out here. We are all set for a very good monsoon. We had an interaction with IMD yesterday that suggested that. Everybody's hoping that or betting on the second half of this financial year earnings to be really good. And that can only happen if companies have decent and robust sales performances as well. So if all of that comes into play, do you think that the markets will forget this Q4 GDP shocker in a hurry?
Yes, if, for instance, we do not have this what I call event risk of disruption as a consequence of the GST introduction, I think the pent-up demand from last year's great monsoon and this year's expectations of a good monsoon will result in noticeable surge in demand across the country, across the board, and that will translate into better earnings, notwithstanding some increase in commodity prices. For instance, we have seen in aluminium, in steel, and so on, prices have gone up partly because of protection, partly because of global tightness of commodities such as aluminium. And so clearly, with all that, there will be growth in profits, and as you point out, there will be a resurgence in corporate earnings.
Now, you know, I was looking at a note from Credit Suisse, Mr. Shah, this morning. They've given their India market strategy and especially headlining Q4, wherein they are saying that the headline numbers are good, but the internals are weak because as per them, if we exclude couple of sectors, noticeably metals and oil, then the top line or the EBIT growth has not been as spectacular as people would have otherwise thought. And you know, underlying trends remain weak. Did you like what you saw in Q4 by and large from corporate India, or hope for more?
In fact, I saw some outperformance which I did not expect, as it were, in some cases. And of course, there were reasons for outperformance. A company like Maruti did so well because they introduced new products, etc., etc. But clearly there was better performance than I expected because the demonetization effect was visible till early March. The distribution of currency has only now pretty much got normalized. And now again, consumption from cash expenditure and so on is going on. There's been some reversal of digitization in payments because as cash becomes more easily available, it's much more convenient than digital payments. But that's par for the course. What is visible is definitely a resurgence in demand. It's not as much as we would like to see. Perhaps it will be noticeable as we see companies talk about it in the next few weeks.
In which case, Mr. Shah, what is your base case assumption of what we do from the market's perspective? Because everybody talks only about one thing right now, and which is that valuations seem to be stretched. Yeah, yes, they probably are. But if indeed earnings come back in a bit of a hurry in the second half or in the second quarter onwards, this market may start looking reasonable as well. I'm not saying cheap, but may start looking reasonable. What is your base case?
Right. No, I think you're absolutely right. If earnings come back, this market will start looking reasonable.
So do you think they'll come back?
Yeah, there's so much liquidity sloshing around worldwide. And of course, even in India today, part of the consequences of demonetization is that there's been an increase in people saving into financial instruments. And you see the SIP flows every month in thousands of crores that's going into the equity markets. So that is providing a buffer. But I think eventually the corporate earnings will show that people who have bought will make money. There is clearly no doubt that it's not a bargain basement market today. You can't just buy across the market. You have to be selective in buying if you want to outperform. And that selectivity comes because we have a lot of opportunity. There are so many under-researched stocks in a large market with thousands of scripts that are listed and at least 1,000 which can be invested in by individuals with reasonable amount of money. There is under-research and under-coverage of stocks. And so if someone has better information or better judgment, one can certainly outperform in such a market.
Let me ask a question which is a bugbear for a few people. We did a poll on the 26th of May, which was 3 years to the Modi government, and 80% of the respondents said that large caps will outperform. Another 20% said maybe mid caps could do that. There was not a single vote saying that for the next 12 months or the next 6 months, small caps could make a difference. Now, traditionally, this market has rewarded good stock picking in the small cap space as well. Do you think that theory is out of the window for now? Or judging by your answer, you believe that there is enough and more wealth to be made in the small cap space as well?
I think there's enough and more wealth to be made in the small cap space if this event risk of GST is handled well. The small cap is most affected by the GST because their compliance costs go up. The compliance processes are so complicated and so cumbersome. I think that Modi's ease of doing business has gone for a toss in this overriding objective of simplifying the tax structure. So clearly the small guys will take a bit of time to adjust to this. The big guys have the means, the big four accounting firms helping them, implementing and so on. So they will be able to address it much easier. But where they are dependent on small guys, either the small guys get hit or they will have to adapt faster. So there is this consequence on the small guys which I worry about. And it's certainly not good for the economy. We need small guys to create jobs. It's not the big guys who necessarily create jobs.
Completely take on board. My final question to you, Mr. Shah. I heard you mention GST thrice in our interaction. I heard you mention consumption thrice in our interaction. Am I to assume that if GST doesn't play too much of a spoil sport, consumption or consumption related stocks could well have a very healthy FY18?
I think so. In terms of profit growth, I'm not talking of pricing. The pricing is already building in some of this anticipation. But clearly, I think their profit growth will be much better. Demand will come back. They've had 4, 5, 6% growth last year. It will be left behind, and we will see much higher growth rate going forward if the GST part is taken care of.
Mr. Shah, I'm sure you have a busy morning, but thank you so much for taking the time out and talking to us on BloombergQuint.
Thank you very much.
That's a very important market voice talking about the Q4 GDP and its impact on the markets, clearly stating that he doesn't feel that the markets will, at least the equity markets will really think too much about the GDP numbers. The markets will move on. Thanks so much for tuning in to Bloomberg Quint.